Let's start with accounting liquidity. The amount of cash a firm has on hand to pay its immediate obligations is referred to as accounting liquidity. In this case, short-term means anything beyond a year. When it comes to liquidity, things are a lot simpler with individuals. You simply need to evaluate their debts against the amount of cash they have in the bank or the marketable securities in their investment accounts. It's a little more difficult when you have firms. The liquidity test compares a company's existing assets to its current liabilities. Analyzing a company's financial statements to determine its accounting liquidity is standard practice. The following factors are typically determined. Current ratio. The current ratio is calculated by dividing a company's current assets by its current liabilities. Cash and other assets the firm expects to use or consume in a year are included in the current assets, while debts due within the next 12 months are included in the current liabilities. Quick ratio. The quick ratio is the percentage of current assets in a company that can be liquidated in a very short period to settle its current liabilities. Add cash, marketable securities, and accounts receivable, then divide by current liabilities. This calculation indicates how quickly a firm may pay off its existing obligations using only its immediately available assets. Acid test ratio. The acid test ratio is another method for determining a firm's ability to pay off its debts swiftly. The quick ratio and acid test ratio are frequently calculated the same way. Subtract the value of a firm's inventory from its current assets and divide that figure by the company's current liabilities in a variation of the acid test ratio. Cash ratio. The cash ratio is calculated by dividing a company's current liabilities by its total assets. What liquidity ratios tell you? A company's liquidity may play a significant role in whether or not to invest in its stock or buy corporate bonds. When a firm's liquidity ratios are high, this indicates that it has a solid financial position to pay its debts. Low liquidity ratios suggest a greater risk of default, especially if the sector or economy as a whole is suffering. Why understanding liquidity is important? A company's liquidity is crucial for a variety of reasons, but primarily because it indicates how readily investors can exit a position. Accounting liquidity, on the other hand, helps investors gain a better sense of a firm's financial flexibility. Understanding your portfolio's liquidity is an important part of risk management. Even if the stock market as a whole drops, you can still settle unanticipated expenses if you have access to quick cash from your stock holdings. What are examples of liquid assets or securities? Money market funds, certificates of deposits, CDs, and time deposits are the most liquid assets. Cash equivalents include things like money markets, CDs, and time deposits. Marketable securities, such as stocks and bonds listed on exchanges, are frequently quite liquid and may be quickly transferred via a broker. What are examples of illiquid assets or securities? Securities that are OTC, over-the-counter, such as intricate derivatives, are frequently quite illiquid. A home, a timeshare, or a car are all somewhat illiquid for individuals, since it might take weeks to months to locate a buyer and execute the transaction. Brokerage fees on top of that, e.g. real estate commissions, may add to the cost of a sale. Illiquid assets such as real property and some forms of art are difficult for individuals to sell quickly, but can be converted into cash if necessary through various means, e.g. auction. Why is one more liquid than the others? A lot of people ponder over why one stock is more liquid than another. The most liquid stocks are the ones that have a lot of interest from different people and which trade a lot. Market makers will buy them because they know how much there is to buy. The stocks for smaller companies have wider bid-ask spreads, so it's harder to sell them without making too much money. Why is liquidity extremely important? Liquidity is defined as the ability to rapidly convert assets into cash and is measured in terms of money on hand and the spread with which it may be converted. The greater your liquidity, the easier it is to fulfill financial commitments, whether you're a business or a person. Simply put, the better the financial health of a company or an individual, the greater its liquidity. When a person has more assets than debts, it indicates they are more financially liquid. Higher levels of cash and assets that may be converted to cash show a healthy financial situation, as they can pay their bills and costs, suggesting greater investments. Has this helped you understand liquidity more clearly? If so, hit that like button and don't forget to subscribe for more weekly updates.